Welcome to this session with Gareth, Deacon, who's the head of multi-asset management, and with Dan Appleby, who's the chief investment officer, with Blackfinch, who are one of our investment partners. And they're going to tell us today more about the Goldcrest range of funds that are available. And we will talk to you as clients about them over the coming months, I'm sure. Starting off, if we could have a brief introduction to Blackfinch as an investment manager, please.
Absolutely. Blackfinch as a firm has been around for much longer, but we adopted the name Blackfinch in 2013 on the anniversary of the birth of Charles Darwin. And it's from Charles Darwin's theory of evolution that we take the name Blackfinch, this being one of the species that he first noticed the evolutionary theory. We take our core values from that evolutionary theory of adapt, evolve, and thrive. And this is really core to our thinking across all of our investment solutions. So specifically the Goldcrest range of portfolios as one of your multi-asset offerings. Can you tell us a bit more about those? Absolutely. So we have many different ranges of multi-asset solutions through Blackfinch Asset Management. The Goldcrest portfolios are really core to our offering here. They are a range of 8 different multi-asset risk-rated portfolios. And we'll talk a little bit more about the nuances of what that means later on. But the key here is to provide a range of solutions that will allow Aaron Tawny to access solutions that will be relevant for all of their clients across different risk ratings, different requirements, to allow clients to meet their financial goals, within suitable risk ratings and those returns that we expect to see from those portfolios.
Okay, great. And those portfolios we talk about, how are those put together?
So we describe them as multi-asset, geographically diversified. So these are phrases. Essentially, multi-asset means that within each of the portfolios, we will use a range of different asset classes, these being equities or company shares, as clients may be aware of, fixed income or bonds, alternatives, property, and cash as well. Cash is a key asset class that we use in the portfolios as well. And what we do, as I said, there's a range of different risk-rated portfolios. And so the asset allocation or the different asset classes we will use across those portfolios will change as we move through that risk profile and those risk ratings. So something like a risk level 2 portfolio, this is on a scale of 1 to 10. A risk level 2 portfolio would be significantly more leveraged into fixed income and bonds and alternatives and sort of diversifying assets that can generate a return, but with very little volatility. Whereas as we move up through that risk scale, certainly as we get up towards the kind of top level risk that we have within the Goldcrest range, the portfolio 9, that is predominantly equity, so company shares. So this is a portfolio then we would expect to provide more volatility, but for that benefit, we would expect much higher return, and therefore it allows Aaron Tawny and their advisors to select the right risk level for each of their clients to help them meet their financial goals at an acceptable level of risk.
And within those portfolios, there's individual funds that make those up. So how do you go about looking for the right funds to put into there?
Absolutely. So obviously we're looking at different asset classes at all times and geographies as well, where each portfolio will be diversified across the globe in terms of us looking for the most appropriate and attractive risk and return for each portfolio at any one time. So what we do with each portfolio is then divide that into underlying funds that cover different parts of the globe, different asset classes. And we use a blend of what's called active management and passive management within those portfolios. And that helps us to really meet the appropriate cost point for that risk return for each portfolio. So a passive investment would be an investment in there typically low cost and is designed purely to track the performance of an underlying index, whether that be the FTSE 100, whether it be the S&P 500, so the key stock market in the US. And they will do that at a very low cost. So we will use those as core building blocks within the portfolios, said to make sure they are an attractive cost and an appropriate cost for Aaron Tawny clients. But on top of that, we can use active management. And active management is a much more sort of human element, human interaction, rather than purely being a quantitatively led passive strategy. And this is where active fund managers will use their skill sets, their analytical research and skills to decide when to buy, sell, or hold different companies from within that index they are attempting to beat. And by doing that, we will have to pay a slightly higher fee to those active managers in order to try and do that. But on that basis, we hope it is our aim to pick those managers that we believe can generate additional returns above and beyond the passive equivalent. And then it's our decision at which point to use active management and passive management to build that appropriate risk reward profile for each of the portfolios.
Okay, that's great. So they'd broadly be blended funds.
Absolutely, yeah.
So a mixture of these things, but designed to be low cost, but give good value to the other Tawny clients.
Exactly, that value is a key consideration in the construction of any portfolio. We don't want to be paying active management just for the sake of it and paying these additional basis points of cost when there's no discernible benefit to the client. And that's why when we're looking for appropriate managers to use within the portfolios, cost and value, and therefore the returns we're generating for the additional cost we pay, we have to make sure that we're making sensible and rational decisions on that basis.
Okay, that's great. And then moving on to the sectors that you currently see value in.
Yeah, so from an asset allocation perspective, I think the government bond market is offering attractive interest rates today. So in the UK, the 10-year government bond, or the gilt as it's commonly named, is offering about a 4.6 or 4.7% interest rate. And this is actually the highest interest rate, really stretching back to just in the lead up towards the global financial crisis of 2008. And at a 4.7% interest rate, this is actually above the expected rate of longer term inflation. And it means that this type of investment is offering what's referred to as a real yield, or an investment return that is able to retain purchasing power across our portfolios, so SIPs and ISAs. And this is a really important characteristic when it comes to things like retirement planning, long-term retirement planning, because it means our portfolios, ISAs and SIPs, again, are able to buy the same things in the future as they're able to buy today. It's a very important concept. Another good thing about government bonds is it is able to add diversification into portfolios at the same times of economic stress, when growth maybe slows and it contracts and we hit recession. Investors usually buy up government bonds because of their perceived safety. And it's essentially because governments like the UK and the US have always paid the interest due on their debt. Of course, we've always got to be cognizant of risks when it comes to investments. And with regards to government bonds, if we see a surging inflation rate, a bit like what we saw in 2022, we would likely use value across our bonds and our portfolios as they try to reprice in that higher inflation expectation. And I suppose that's any conversation on value and valuations isn't complete without talking about the UK stock market. And if we compare UK stocks to a basket of global stocks measured by, say, the MSCI World Index, UK stock markets and stocks are trading on about 40% discounts to global stocks. And this is the widest discount, really stretching back till the turn of the 21st century. And it's why Gareth mentioned before, FTSE 100, we've got an index fund that tracks the FTSE 100 in the Goldcrest portfolios, partly because of the valuations. It offers attractive income, and it also adds diversification in there, say, versus the government bonds that we would look to buy. But we do want to see economic growth pick up in the UK if we were to look to increase exposure to maybe some of the smaller companies listed in the UK on the London Stock Exchange.
Right, okay, interesting. So I think you've covered slightly some of the geography of that, but opportunities when we look forward as to where those potential returns are going to come from.
Yeah, absolutely. I think there's always going to be opportunity in the US market just because of its size and its dominant technology sector. So the biggest technology companies today in the US, and they are the Apples, Nvidia's, Microsoft's, Amazon, Alphabet, commonly known as Google, and Meta, rebranding from Facebook, and also Elon Musk's Tesla. But if we just focus maybe on Nvidia for the moment and what are called hyperscale companies, so the Microsoft's, Amazon's, Alphabet's, and Meta's. The reason I call hyperscaler companies is because they're investing heavily in what are referred to as hyperscale data centers. And these types of data centers are able to really scale with the demand of using things like cloud computing that we all use commonly nowadays, and are able to crunch vast amounts of data that enable things like artificial intelligence and AI-based software. And these hyperscale companies, those four, are investing heavily in this area to the tune of billions of dollars to expand their data center footprints. And a lot of that investment is going to work its way into NVIDIA's revenues because NVIDIA developed computer chips that go in to power these data centers. So we really like to hold an exposure to these Magnificent Seven stocks in the portfolios because there's no signs of any sort of slow growth in this area. Quite contrary, actually. But just in terms of opportunities, more of a nascent area of the technology sector is quantum computing. Now, Microsoft, in partnership with Atom Computing, announced a bit of a breakthrough in this area at the end of last year at the Microsoft Ignite conference. And essentially, quantum computing uses a property in quantum mechanics that allows these types of computers to solve problems way quicker than a traditional computer. So anything from sort of thousands of years that it would take a traditional computer to solve, quantum computing can do it in a matter of hours. Now, it's very early stages in the development of this sector, so we're not going to have sort of quantum computing mobile phones in our pockets anytime soon, but it's an exciting sort of area of taking something we're keeping a close eye on as well. And then just lastly as well on the maybe areas and geographies that we're maybe looking to avoid. I think broadly speaking, the biggest risk in markets still today is an uptick in inflation, as we touched on before. If inflation surges again, we would likely see weakness across our stock and bond markets again, a little bit like what we saw in 2022. And this is why we always advocate for diversification across the Goldcrest portfolios. But of course, we've just seen Donald Trump return to the White House as US president. And again, he's threatened to impose tariffs across world trade again. So we are acting with caution, allocating areas and regions that depend a lot on exports to drive their economies. And just until we get more clarity on what Trump intends to do with these trade policies. So an example country here would be China.
Okay, no, very good. And then we've sort of touched on it already, but leaning towards the Goldcrest portfolios themselves for this 12 months. So thoughts and plans for the funds themselves?
In terms of the range of funds that we have currently on offer through the Goldcrest range, we have 8 portfolios, as I said, 8 risk-rated portfolios at the moment. All of those are managed on a total return basis. So the key objective of all those portfolios is to be capital growth. What we're looking for to add to the range, and will be coming in the coming months, is actually income portfolios. And Dan's touched already on the fact that actually there is significant yield available across the markets for the first time in a long time, really, for clients. So what we're looking to add at this point is 4 income targeted portfolios to have a dual mandate there of both capital appreciation and income, just for those clients, maybe those in retirement who need to be taking an income from their portfolios. We'll be looking to add 4 more portfolios to the Goldcrest range that will then be accessible to the Aaron Tawny advisors for use for their clients. But broadly, the Goldcrest portfolios are performing well, as that they're meeting the objectives, and we have regular contact with yourselves as a firm to ensure that everything's performing as we would expect as a firm and as your clients are hoping to see. And yeah, absolutely, we hope for that to continue, and we think that adding these additional 4 portfolios will give us an even broader scope for the touch points for your clients to help them meet their financial goals.
Brilliant. So I think that sums up quite well the Blackfinch range of funds that they offer for our clients through the Goldcrest range. And we thank Dan and Gareth for their help and support today in providing that valuable insight into how it all works. And we hope you've enjoyed this session.